Hello and welcome to the third in CoinDesk Research's webinar series. Subject today is lending and staking, and we're joined by Jordan Clifford of Scalar Capital and Kyle Samani of Multicoin Capital, two fund managers of crypto funds that are long in crypto assets, specifically Bitcoin and or Ether. And what we're going to talk about today is earning interest or income on those assets. So what I want to do is start by setting the table with a little bit of data and detail on this lending and staking market. So if you look at the one factor driving participation in the market is people holding large balances of crypto. The slide up here right now shows the number of Bitcoin balances over 1,000, which has been growing in 2019, as some other observers have noted as well. Although it has dropped off slightly since its peak on the year, we've seen growth in that number, and that may indicate more people with large holdings who are looking for ways to buy and hold and earn income as they go. Another piece to look at, of course, is just the simple volumes of lending over time. You can see, this obviously reflects the price of the underlying assets. So when Bitcoin and Ether are at a peak, you're going to see greater dollar volume, but nonetheless pretty steady growth month to month in net new deposits on crypto lenders and DeFi platforms. So that's really looking at the lending side of things. I want to jump in and invite our guests, Jordan and Kyle, to talk a little bit about their funds, their strategies. So let's go in alphabetical order. Jordan, why don't you get started with, let us know kind of what Scalar Capital is, your positions in Bitcoin and Ether, how much of the fund is dedicated to this just long in what I would consider base assets in crypto, and kind of generally speaking, how you think about those investments.
Thanks for having me, and happy to explain. So Scalar Capital is a first crypto asset investment management firm. We have a fund that's structured as a hedge fund that we offer to LPs, and we have high conviction in crypto assets generally. So Bitcoin and Ether, we definitely feel like they're really important assets to have exposure to. They comprise anywhere from a quarter to half of our fund at any given point. But we generally are trying to create a portfolio of high conviction bets across the space, whether it's early stage in ICOs or all the way up to Bitcoin. And then we are a long only fund and with a long-term horizon. So we do like to take advantage and utilize as much of our capital and balance sheet as we can. So we have found ourselves doing some staking and some lending just to try to bolster returns, and that any accretive thing we can do for our LPs is something that we try to do. So that's just a super quick intro. Happy to get into a lot more, but just want to.
One question I just add on that is, Jordan, what percentage of the fund is in Bitcoin and Ether?
So I don't want to give up exact percentages. It's a little bit of our secret sauce, but it's substantial, between a quarter and a half, or even a little bit more.
Okay, good. Kyle, go ahead, please. Let us know about Multicoin Capital, general strategy, and also specifically with regard to Bitcoin, Ether, long strategies there, and how you think about lending and staking.
Hi, everyone. My name is Kyle Samani. I'm a co-founder and managing partner at Multicoin Capital. We're an investment firm based in Austin, Texas. We have 14 people in Austin, New York, LA, and Beijing, managing a little more than $100 million across a hedge fund and a venture fund. We invest in early stage teams, equity and tokens, and all the way through Bitcoin and everything in between. We in the public markets invest both long and short. We participate in staking, we participate in lending and borrowing. So pretty familiar with kind of the overall market on kind of all of these fronts. That's a very quick overview in terms of Bitcoin and Ether. We're in this full time because we're long-term believers in what we do. We have certainly a long bias At this point in time, longer Bitcoin than ETH, but long both.
And what share of the fund are you investing in those assets, Kyle?
I mean, it's varied at different points in time. We don't disclose like what that is, and we have no kind of mandate to be within a specific range. It's been in the negatives, it's been in the positives, it's been wide range.
You know, one of the questions, obviously, the first question is sort of what are the rates that people are earning with lending and staking, and I'm just advancing through slides here to show the one I think you guys have seen, comparing some of the rates offered by crypto lenders and DeFi on deposits. Pretty wide variability there. Want to get your impression on what you think is what's a rate that makes depositing some of these assets with a crypto lender or depositing them into a DeFi contract. What kind of rates make that meaningful, and how do you think about these numbers? And I'll just leave that open to either you guys, whichever you wants to jump in.
Yeah. So I mean, obviously,
or maybe I should.
Go for it, Jordan. You can kick it off.
Sure. So obviously, these rates are variable, and they're something that we definitely keep track of. Definitely the DYDX ETH rates. They look pretty low there.
Right.
But it's important to take into context. What's your balance sheet like, and then how you evaluate the risks. And I think I have a lot more to say about the risks. But as far as these rates, yeah, I mean, it's just important to take into account the whole picture. And I think the risk is really the more important discussion here.
Yeah. Yeah, I should mention that this is just a snapshot, and these rates change quite a bit over time. Sort of similar level of kind of volatility in the rates as you might see in the price. So yeah, that 0.03 and 0.02% rates, I think those were in the single digit percentages just a couple months ago for DYDX and Compound, if I'm not mistaken. Kyle, anything to add to that in terms of what's a meaningful rate of return when you think about lending or staking?
Yeah, I mean, today, if you want to lend Bitcoin, returns are quite low. I think it's on the order of 2-ish%, maybe 3% if you're lucky. So the returns you're getting are overall rather immaterial. Given how low the returns are, you want to make sure it's all about managing risk here. And so whatever broker or a desk you're working with, whether it's BlockFi, whether it's Matrixport, Babel, whoever it might be that we're Genesis Capital, Galaxy, whoever, you want to make sure you're very comfortable with their, obviously, risk management processes and procedures, understanding their collateralization ratios, understanding where you fall in the capital stack in case anything happens, understanding the volatility of the collateral they're accepting in exchange for those loans they're handing out. So that's really the key. I agree with Jordan. You really, given how low the return is, and at least lending Bitcoin to ETH, you want to make sure that the desk you're working with is helping you out. If you're lending through one of the DeFi platforms, whether it's Compound or DYDX or Nuo or any of these other ones, it's harder to kind of underwrite that risk, I'd say especially as a fiduciary. While I love to kind of support these DeFi platforms in theory, the one thing I kind of refuse to do is to be in a position where I have to send an email to my LPs and say, hey, LPs, we put your money in this weird contract and the contract blew up, and sorry, the money's gone. While every day that goes by, that risk does, decrease, we are still not comfortable kind of taking on that risk at the firm level. I hope we get there soon, but not quite there yet. And so, we're not using the DeFi platforms for any of that stuff, but I hope we get there. So in the interim, it's all about really underwriting the lending desk that you're working with. Fortunately, there's a lot of very professional, very good firms out there today, some of which I mentioned. We've had a good fortune of working with most of them, and they're generally very professional, well-managed firms.
So I think we're going to get pretty quickly into risks here, but I guess I want to dwell on the rates a little bit more. I mean, considering how low these rates are, even even on the high side of that table, does it matter? Why bother? I don't know.
Yeah, well, so as Anna and I both mentioned, these rates, and you've mentioned yourself, these rates are variable, and we've actually put some of our capital to work at rates that are substantially higher, as high as 15%, or even a little bit more. on DYDX. So, it's definitely something to monitor. And, if you have idle capital and you are willing to, underwrite that risk, it's kind of makes a lot of sense to put it to work, assuming you're comfortable with the risk. Yeah, I guess the risk is really the meaty part of this discussion, though. I think we're both kind of itching to talk about those.
Yeah. No, I guess what I'm trying to get at is sort of what's the point at which this is sort of worth doing?
I could speak to the DeFi side because we've actually been active on that front. So, as far as risks, you really are thinking about counterparty risk as the main one. And that comes in many forms, actually. It's not so simple. So many of these DeFi contracts, they have administrator access that can, do various things with those funds at the contract level. This is kind of a early stopgate for many of these smart contracts to go live before they can be truly, decentralized and whatnot. So that is something to think about. Like it says it's a DeFi protocol, but often there's really a single organization that has keys to it. But that said, the smart contracts themselves, they present that they act as the counterparty in a way, and those smart contracts need to be vetted for technological risk. So technological risk, it's always there. It always will be there. There's bugs in probably every smart contract. But what you really are looking for are smart contracts that have had a lot of value custodied within them. And the more time that's elapsed, the safer it tends to be. So if the contract's held $1 billion for several years, the odds of it having a serious vulnerability diminish over time. We also like to see smart contracts within the DeFi protocol that offer bug bounty programs. We found that those are really good at ferreting out some of these harder and obscure bugs. Security audits are really important, and then formal verification is a process that developers can use to kind of prove out their smart contracts that they perform correctly over the universe of inputs. So we like to see all those things, and it ends up being a judgment call. And you have to look at the interest rates from before, as well as your overall balance sheet and how much capital you're willing to risk on a given strategy or on a given loan.
Kyle,
but then
you're on the other side of that judgment call, am I right? Like what makes you want to say basically no to all of that?
Yeah, I just think of all of the emails I can send an LP, and email that I really don't want to ever send is "we lost your money." That's
I mean, of course, like nobody wants to send that email, right? But I mean, you obviously evaluate the risk that you'll be sending that email a little bit differently than Jordan does. I mean, is there a point at which you would say, okay, the risk is, the risk is low enough that it's worth the potential return here?
Yeah, there may, in fact, not there may well be. There will be at some point in time. We haven't sat down internally and kind of thought, okay, well, is it a 1% premium over centralized? Is it 2% premium? At what premium are we willing to underwrite that? We're not there yet. I hope we will be in the next 6 or 12 months, but there's no formal time frame on which we need to make that decision. The good thing is the arbitrageurs generally will keep those rates in line with each other. And so it's unlikely that the premium between centralized and decentralized lending is going to be that substantial, because there are other people who will, bridge that arbitrage.
So can't you always just to kind of get the conversation going, keep it going? Can't you size the position to kind of adjust for that risk? I mean, we don't have 100% of our portfolio in DeFi. We never will. We have a single-digit percentage, and on the low end of that, to be honest, executing these strategies. So you can kind of draw like a boundary in 50 basis points. But I guess your point is that the risk premium isn't necessarily justifying it. So that's fair.
Correct. Yeah. Again, we knew that even if we were to do it, it wouldn't be a meaningful percentage of the portfolio, and so it wasn't worth the time.
Mm-hmm.
So I got a question coming in from a listener here. I mean, this is good stuff. I think we can kind of continue on this thread, but I want to sort of try to chime in with listener questions as they come in here. And this is related. In the case of companies offering instant liquidity for their interest-bearing programs, is there a danger to overpromising in the case of a run on the bank? And I think that's, goes to some of the factors, Kyle, you were talking about in evaluating an agent or a broker. Are you sort of looking at how quickly capital can be withdrawn and thinking about that as a parameter there, and sort of how do you think about that issue specifically?
Yeah, absolutely. This is one of the key risk parameters we always think about. I'd say that 18 months ago there was not a lot of standardization around these terms and clauses. I think there's been a lot more standardization in that time. I don't know necessarily if there's a standard clause that most people are agreeing to, but right now most loans are callable with 30 days notice. That tends to be standard. Sometimes it's 15, sometimes it's 45, but that kind of tends to be the range. What's good is that in that time range, if you're a lender, then you obviously have to agree to that term. But the good thing is that for any asset that's reasonably liquid, you should be able to reasonably expect that the borrower can in fact, return the asset with 30 days notice. That is a generally reasonable assumption, especially with enough collateralization to accommodate any additional risk.
Let's talk again about the DeFi sort of issue there. I want to actually go back a little bit on something Jordan was talking about in terms of technology risk, because that really does seem to be the really salient risk factor there. Of course, bug bounties, third-party audits. Jordan, is Scalar conducting its own audits internally of the DeFi contracts that it's looking at?
I do review the code, but I wouldn't call it a security audit. I'm not a trained security engineer. I'm just an ordinary computer engineer. So
just wondering kind of how you think about that. Is like there are third parties you can trust. There's no, you don't need to sort of, sort of do that yourself. In other words.
The more eyes, the better in my mind, and the more time elapsed, the better. So, I do review these contracts myself, but again, I'm not a security audit firm. Yeah.
And then on the formal verification side, how widespread is that? How often do you find that?
It's trending. It's still early. I'd say a third or less of the platforms probably do at this point, but it's definitely, I think, the future of smart contract development generally, whether it's DeFi or otherwise. I mean, if you're going to be locking up people's value and you're going to say code is law or even anywhere close to law, you need to make sure that code works and it does what it's expected to do. So definitely see that as a trend that's growing in importance.
Do you also think about governance in terms of decentralized governance structures as a risk factor alongside that sort of code is law, but there are people involved here, and so the parameters of that law are going to be set one way or another. And I think you might even have people introducing things like Aragon Court, for example, with a kind of a decentralized dispute resolution type of a approach. Curious whether you think about those governance structures in the same breath as thinking about the technology risk in the code itself.
As far as evaluating whether to invest or
evaluating a DeFi provider, is that smart contract going to be secure based on what the what rates might be set by the stakeholding community in the future, for example, that sort of thing. I guess I would think about the governance as a potential risk of, this might change the terms of things here, or it might, create a security risk as well.
Yeah, I mean, I guess the governance risk is almost in the same line as, the admin risk. Like, some of all these contracts have admin keys. So governance, in a way, it's a bit better because theoretically it's more influenced by more people and more stakeholders than just the smart contract operator. So yeah, I mean, I think that the governance it tends to be something we consider the governance, but I don't think that's usually the deciding factor, to be honest.
What about in terms of, and I don't know that this is, well, I guess this could be a factor on either side, capital requirements. Are you sort of looking at that threshold, of how much capital is required? And I think we were talking about, evaluating the risk. How much are you going to put in? Are you finding that capital requirements are feeling high, or is that not really an issue that comes up when you're thinking about, this kind of investment?
Yeah, so for us, we're long only, long-term focused. So capital requirements tend to not be really too much of an issue for us. It's, we do have to think about the capital requirements in context of the opportunity cost and where else we could put that capital. But for the most part, if we like the strategy, we've vetted the risk and are comfortable with it. Those lockups and capital requirements aren't really a deterrent to us because we are so long-term focused.
Got it. Let's talk a little bit about, in terms of those decisions, I want to talk a little bit about staking as well. And just kind of on a baseline level, the opportunity to, right, if you hold a proof of stake coin, the opportunity to stake it and earn income for staking it. Do you guys view that as a sort of a competing product that with lending, for example, that you might be sort of putting it into a DeFi contract or depositing it with a lender, or on the other hand, you might be staking it with the network itself? Kyle, do you have any thoughts on kind of, is that apples and oranges, or do those two really come up against each other in terms of your decisions?
For now, the assets that we are staking, there's generally no lending markets for, so it's not really a hard decision. I think as, ETH 2.0 comes out and as kind of all the next-gen chains launch, that'll start to become more of a question we'll ask. In general, my expectation is that lending and borrowing rates will be higher than staking rates. I think for the most part, staking rates, at least within each ecosystem, will be considered the risk-free rate. There's some problems with that, mainly unbonding periods. But I think there's going to be quite a few kind of weird workarounds, especially when you're staking through exchanges. So my sense is that for the most part, staking rates will be considered risk-free, and that lending and borrowing will, have some premium to that.
Risk-free because the risk is lower, or risk-free? What reason would I choose? What reasons maybe would I choose to stake rather than deposit with a lender?
Yeah, I just said it's native to the protocol. There's very few things that are native to the protocol, and that is one of the few things that's native to the protocol. And so my sense is why deal with borrowing and counterparty risk when you can just rely on the protocol? Like, you're already relying on the protocol anyways.
Right.
So stake, you might as well rely on the protocol and take counterparty risk, and so you should be compensated for that additional form of risk as a lender.
So walk back a little bit, and you mentioned I didn't quite catch it, but something related to bonding and how that might complicate that picture a little bit. Did I get that right?
Yeah. So in quite a few of the proof of stake systems, there's some unbonding period, meaning that if you're staking your tokens and you want to be able to sell them for whatever reason, typically there's some period in which you need to unbond those tokens. That unbonding period ranges across different assets. For example, I believe for ETH 2.0, it's expected that period is going to be something like 30 days. Some of the other proof of stake networks have shorter unbonding periods. I think Tezos is an instant or maybe 24 hours. It's relatively short. So if you have a 30-day unbonding period, there's some reason to believe that actually maybe borrowing and lending rates would be lower than staking rates. However, one weird variable, there's kind of two major confounding variables here. The first is exchanges. It's becoming a very clear trend that exchanges like Binance, like Kraken, like CoinDesk are going to offer staking. And so if your capital is pooled with a whole lot of other people's capital inside of a bunch of Binance validators, it seems pretty likely that Binance will offer effectively instant unbonding, because they can afford to do that because they're effectively, mixing like your funds with other people's funds in the kind of stake validators. And I expect that will be a feature actually that many exchanges will brag about, because it actually provides a better user experience for the asset owners. The other kind of weird kind of variable in this is what's called staking derivatives, and these are a little bit more complicated. But there's quite a few people who have basically indicated that they will just create wrappers where basically you can basically take an ETH, let's say, deposit it in a contract, get an asset that's basically a claim on ETH, and then take that underlying ETH, deposit that ETH, to stake it, and then basically you could actually take the wrapped ETH here or the claim on ETH and sell that. And if there ends up being a liquid market for that claim on ETH, then that's a staking derivative, and you would basically be able to liquidate your ETH instantly, and then whoever's buying it from you obviously have to wait 30 days, and so that would trade at some discount. So there's all kinds of weird kind of workarounds to those core unbonding mechanisms. We'll see what becomes prevalent or not. I'm a little bit more skeptical that the latter will become a liquid market. I think there will be some market for it, but I'm somewhat, given that what we know that exchanges will almost certainly do, it's not clear to me if the actual staking derivatives will ever be more than kind of a theoretical construct.
If they are more than a theoretical construct, and there are workarounds on the sort of lockup period implied by the unbonding period on these proof of stake chains, is that a risk? Is that a security risk, or sort of how would you think about that in terms of whether that's a good staking investment or not?
That is objectively a form of risk, yes. That explicitly is a way to get around some of the security parameters in the system.
Yeah. I mean,
will it matter? Unclear.
Right? Yeah.
Will it matter is unclear, but certainly it is some form of risk.
Yeah. Jordan, anything to add on this, sort of thinking about staking versus lending, and again, I mean, as Kyle pointed out, that this may be a kind of a decision that is sort of coming in the future with ETH 2.0 and more lending options for current proof of stake chains, but wonder if you have any sort of thoughts about how you would view the two between a decision between staking and lending.
Not a ton to add. I agree with Kyle. That's not really a decision right now. The asset, there's not overlap in opportunities between lending and staking.
Thinking about, I'm looking at this slide here that we've got up on some of the rates on staking assets. The nominal yield is stated in the y-axis, and the x-axis shows the real yield. This is information from Staked, which is one of the staking, and I think they also do lending agents that's operating. And of course, again, just a snapshot. I know these rates change, but does provide a picture of kind of the variability between rates here. Does this, how do you guys think about rates in staking? Does this look, like what you'd expect? And sort of where do you fall on kind of what you would be looking to earn on any assets that any proof of stake assets that you're working with in this way?
And so the way I read this is that a lot of these platforms just haven't gotten very far along their emission curves. I don't think that staking yields ultimately at rest, in the long-term perpetuity, should be much higher than 5% at the high end. That seems a bit high. So what this tells me is that a lot of these assets just are still trying to get their supply into circulation. So these you can think of it as a risk-free rate in a way, but at the same time, it's all the staking kind of emissions is dilutive. So it's, as far as like a real yield, you are kind of keeping pace with the overall supply increasing and making sure you're not getting diluted by staking. And I think it's really important to do so. But these rates are not sustainable.
Yeah, I wouldn't think of, a 28% rate, that's a pretty interesting number on LivePeer. Also a pretty interesting asset in a way, one that's been around a while and actually I think is actually used for things, which is pretty rare. But yeah, I think so the real yield here is does factor in inflation.
Okay.
But so I guess what you're saying is some of these assets are sort of offering a high rate in order to get those tokens staked and in play, and to get the network effects that they're desiring from that. Is that?
Yeah, I mean, any crypto asset either has to have a large genesis block where a lot of stakeholders already invested into it, or it has to kind of get its supply into circulation over time, like Bitcoin did, where there was the genesis block had nothing in it, or just a single Coinbase reward, but it's not even spendable. So, yeah.
Cool. Kyle, any further thoughts on that topic in terms of rates and staking? And I mean, I think it seems like both of you would view that sort of staking rate as a risk-free rate that would be referenced throughout the asset category. Is that or for any use of that asset? Is that fair to say?
I guess I would have a little bit of a discussion.
Go for it, Jordan.
Sorry. So I just wanted to just chime in. I don't necessarily believe it's a risk-free rate. I think there's a slight amount of risk at putting your capital into staking where, if you screw it up or configure your thing wrong, there's a little bit of technological risk. So
Sure.
Close to a risk-free rate, but I wouldn't consider it to be one myself.
Makes sense. Right.
I agree. I'd agree in the short term. I think in the long term that will become the market reality. I agree with Jordan that these rates will all collapse to below 5%. Today, I think a risk-free rate is intellectually dishonest, but that's where it's trending over a long period of time.
What do you mean intellectually dishonest?
I mean, the risk right now is high. Just staking is new. The software is new. Everything in these systems is just new. So that's all I mean. I called it a risk-free rate. That was my semantic error on my part. But I do think 10 years from now that will be the market view. Yeah,
right. Yeah, I think it's fair to. I mean, a risk-free rate is a risk-free rate because everybody agrees it is, right? It's sort of not. There really is no risk-free anything.
Right.
I suppose, right? So in any asset category, so I guess it's a matter of some kind of consensus developing around what that rate should be. I mean, it's the staking rate seems like as plausible an idea as any. Any others in terms of ways that rate could be constructed that you would think about?
Yeah, so the closest thing I can think of to a risk-free rate would be like the USDC savings rate at Coinbase, but that's not even really risk-free. I mean, you have counterparty risk with Coinbase. You're trusting USDC is going to hold up and not be frozen or subject to some sort of technological or attack. And it's also not available to all participants in the world. It's right. Only, I think, U.S. customers. But that's probably the closest thing I would say. And that's 1.25% right now.
So, I mean, I guess one question, here's another one coming in from the audience. I think this goes back to what we were talking about a minute ago. And I mean, and this is, I think if we can sort of send around after this a link to a paper that's recently written about this to participants listening. I mean, is there a risk that over time lending sort of reduces the security of proof of stake protocols? If lending rates are more attractive than staking, and you see more of the asset flowing in that direction, are you sort of then, looking at a proof of stake protocol that's been compromised somehow?
I guess I'll take this one. Yeah. So the author of that paper, I believe, was Tarun Chitra and Haseeb Qureshi from Dragonfly. Friends of both of them, both super smart guys. So they kind of outlined a series of plausible attacks in DeFi and proof of stake systems and lending markets that could adversely impact security of these systems. I'm not super worried about these attacks, at least in any foreseeable time horizon, for a few reasons. One is that the known solution to these systems is to have inflation in proof of stake systems, and to the best of my knowledge, every single proof of stake system is inflationary. So that's and has kind of a dynamic inflation reward. Dynamic staking reward. So the known solution is by and large kind of considered the standard answer. The exact parameters that you should tune are still unclear, but the general solution is known. The other reason I'm a little bit I'm rather not concerned with this attack is pulling this attack off at scale is extraordinarily difficult and risky. Even for small cap assets, the problem is like running a short like this on a small cap asset is very just like risky because someone can easily squeeze you on the other side. And for large cap assets, if you're going to do this with $100 million of capital, the number of people on the planet who have that much capital, who have the sophistication to pull this off, and have the risk tolerance, I just find to be extraordinarily low. Basically zero. So At least for the foreseeable future, I don't really worry about it. 5 years from now, we'll see kind of what capital markets look like around these assets. But in any reasonable time horizon, I don't think it's really practical.
Yeah, I think Kyle's right that the scale of at which to pull off one of these attacks, at least on one of the major networks, is just very intimidatingly large.
I want to talk though about some more sort of larger kind of impact issues about lending. Crypto is in this interesting place where, having been on the planet for 10 years, we're now seeing, real momentum in the introduction of lending. Like in the past 2 years, right? It's grown, and I would wonder kind of what the what the likely impacts of that might be. For example, on liquidity, typically lending. One of the reasons maybe that crypto markets aren't as liquid as we would desire them to be is because their lending is immature. Do you think there's an impact, sort of in terms of the maturity of markets that lending brings about over time? And I guess, Jordan, I'd invite you to kick that one off if you like.
Yeah, absolutely. I think lending and shorting, all of these activities, derivatives, these things add to price discovery, and they result in just a more robust price discovery process with people expressing more views and people being able to utilize their capital more efficiently. So I do believe that liquidity will be improved as the lending markets become more robust. What's the second part of that question?
No, that was really, I think, can you talk a little bit, I guess, maybe in the specifics of kind of how that might happen, how you might see that evolving over time, and what if derivatives contribute, for example, a certain amount of liquidity in the market, what are the ways in which, lending and DeFi growth there might add liquidity in crypto markets?
Sure. So, financial markets, they kind of feed off of each other, and the derivatives markets, the lending markets, the spot markets, the activity on one, arbitrageurs will make sure that all the markets kind of line up and kind of stay in sync. So the more venues and the more avenues that people can participate in these markets, whether it's, borrowing or through derivatives or through brokers or whatever that tends to be, the more avenues of participation, the more trading activity and the more, volumes will increase. And theoretically, you should have a more robust price discovery. So that just means that you have more opinions kind of being expressed into the market. Whereas right now, a lot of those opinions are not being expressed because they don't have a comfortable way to express them. They don't have access to borrow to short, or they don't have access to, short a future or whatnot. These markets are still pretty nascent, and it's going to take time for them to develop. And as they develop, you should see just more robust volumes across the board.
Kyle, anything to add on that?
No, I think Jordan nailed that one.
Yeah, I think it seems like one of the major sort of inhibitors, and this is a little bit of a different topic, but the inability to trade on credit in most of the crypto exchanges, the crypto spot exchanges, is a real limiting factor on liquidity. So I guess could see a world in which growth in crypto lending contributes to the ability to do that. But right now, it feels like there's not that many spot markets that offer meaningful margin. Any brief thoughts on that?
So margin is it's a little bit of a double-edged sword. Like, it does add liquidity, it does improve price discovery, as I've mentioned. I guess the potential other edge is that you have risk of cascading margin calls and whatnot, especially if people are doing so in a kind of overstretched way. So we want participants to kind of stay within their means as they express their views. But if you get some irresponsible speculation happening, that can go badly.
Yeah, I think you see that in the derivatives market. Obviously, those are the sort of salient examples of that today. We did have a listener with a question about the chart we were looking at earlier, and this chart here, by the way, is just a look at volatility and liquidity across some of the exchanges in the market. not specifically related to lending, of course, but some, maybe a picture that you might expect to see improve if those, if lending does continue to grow as it has. Looking back on the chart showing staking returns, I think, we had one listener who had a question about the negative returns on some of those. So those are, I think it's a fairly straightforward picture of basically the inflation rate is creating a negative real yield on the staking asset. I think whether that's sort of a long-term picture for those assets or not, I think is a question. Any comments, guys, on kind of negative real yield on some of these things? Is that something that you guys have thought about?
You want to take that, Kyle?
So you're saying a negative real yield in the sense that the price may go down more than the staking reward?
Yeah, I mean, as in the sort of when you factor in inflation, when you factor in the inflation rate of the on the network, you end up with a negative number.
Yeah, I mean, in all of these systems, if you are participating in inflation, then you are by definition beating inflation, because not 100% of people are participating in inflation. So in that sense, you're always getting a real return. It's not like the government will offer T-bills at some percentage, and inflation may be higher. Those two things are directly tied together. The more real risk is the USD denominated return negative, and the answer is it's very probable given the volatility of these assets. In general, right. I don't think of it as a viable strategy to stake for yield as a way to generate returns. I think of staking as a way to get more exposure to an asset that you already want to be long.
Yeah. Yeah, I think that makes sense. So want to go back to something here, looking at, we've got a few minutes left. Couple new questions from this slide here is, again, I think we presented this early on in the presentation, looking at sort of the growth in some of the DeFi and lending platforms. I think that sort of ties into this question about sort of what are the macro impacts of this kind of growth. I think one sort of general question I put to either of you guys is, how do you see the sort of long-term prospects for crypto lending? Are we going to continue to see this sort of modest level of growth, or is this something we should expect to see a real ignition in this market and take off? What do you think, kind of sort of predictions or sort of loose preview for what we might expect to see in the coming year?
So this slide, net new deposits, that seems like fairly substantial growth. I mean, if you're getting 150 million in incremental deposits each month, generally, I think
absolutely, yeah. No, I'm not saying it's. I think it's no, it's definitely substantial. It's not it's growing month over month. It's not like the sort of it's not going crazy, but it's definitely grown quickly here, and seems to be picking up in terms of the pace of growth. But again, of course, this is denominated in dollars, so you're seeing the price reflected in some of that, right?
Sure. I think we'll see DeFi and lending generally just continue to grow. Probably not in sort of a inflection point hockey stick way anytime soon. Just continue to kind of just organic growth, I think, is what we're in store for. I think that some of these DeFi protocols can provide better interest rates than a lot of other options. So as kind of the search for yield intensifies and as these protocols become more mature, I think we may see some people kind of become a bit more comfortable putting some of their money into stable coins, into a DeFi savings account type of a vehicle. I think that that's something that could bring in new users in 2020 and beyond. As far as borrowing assets, I think it's still not something that's going to bring in new users or increase adoption too much. It's really quite cumbersome, and you have to have access to a lot of crypto to over collateralize and borrow at this point. So we'll need to see, more robust systems in terms of identity and reputation, and to the point where you can actually have partially collateralized or even unsecured loans. I think that would be a big thing for a lot of people to come in. But right now, I think that lending out stable coins and getting 3 or 4%, that is pretty attractive if you look at the grand scheme of things, where interest rates are pretty dang low. at least it's available to consumers.
Yeah, that seems like the big question here is sort of is DeFi, is lending something that is sort of attractive to people who have already bought into crypto, or is it something that can be a sort of an on-ramp? Kyle, any thoughts on that? Is this, are we looking at something that could be the thing that involves more people in crypto assets, or is this really something that for now at least is sort of an additional benefit to people who have already got involved for other reasons?
Yeah, I have concerns about like when I call it kind of the invisible asymptote problem, which is that today DeFi is, I mean, it's actually pretty clear now that it's pretty circular and that like there's not too many people actually using the product. It's maybe a few thousand, but that it's not like it's not growing meaningfully. And the upper bound here seems to be basically the market cap of ETH in terms of like what could happen or some fraction of that. The thing I'm really looking for in DeFi is figuring out ways to get uncollateralized loans and figuring out ways to serve underserved customers. So like if you live in the US or the EU, you for the most part are being served by the existing financial system. There is about 20-ish% of the United States that's being underserved by the financial system. But even that segment I don't think is the right target for DeFi for the most part. My sense is that people who really are like DeFi targets live in China, Southeast Asia, India, South America, Africa, maybe parts of Eastern Europe. Like those are really your target users for DeFi products. And I think the real challenge beyond getting them stable assets or even volatile assets is how do you get them uncollateralized or at least under collateralized loans to kind of increase the capital efficiency of these systems. I think the like big aha moment will be figuring out how to do under collateralized or uncollateralized loans in these systems. That is very likely to involve some form of identity. I think it's going to be very interesting to see what kind of makes its way over from legacy systems versus what's kind of the new ways to underwrite. But I think that's really the big kind of breakthrough moment to make DeFi, to be able to really help DeFi expand meaningfully beyond kind of its current market size, which I'm not convinced is much larger than the status quo.
I think you're right, and I feel like we've gone from a kind of a naive assumption that DeFi will do some of those, will provide sort of bank the unbanked, if you will, and sort of expand access to capital in some sort of magical way. And now there's been a sort of a little bit of, at least from my perspective, some disillusionment and thinking, okay, this is a more difficult problem than initially appeared. DeFi may have some role in it, but there are other components that need to come into place as well. Any sort of thoughts before as we wrap up here? Kind of what are the components that can bring crypto, decentralized finance and lending, outside the sort of insular group of people who already hold the asset for other reasons?
I think it's just going to take time and, word of mouth, and as well as just user interfaces and applications that actually make sense to people. I think that right now, this stuff's still pretty clunky. So we just need to polish off the rough edges, get more time, have more, people talk about their success stories. And yeah, I think organic growth will come. It's just, kind of going to take a while.
Things like sovereign identity, credit ratings on a decentralized basis, are those sort of part of the picture?
They very well could be. Yeah, I think, access to credit is something that not everybody has great access to credit, especially in the developing world. So, microloans and identity that allows these kinds of things to happen, it could very well be a part of the picture.
Yeah. Kyle, any last thoughts on that?
I think the things specifically I am looking for are better key management systems. We've made one investment this year in the key management space in ways to kind of make that. I think that's one of the hardest kind of user experience problems. The fiat to crypto bridge is way better than it was 12 months ago with services like MoonPay and Wire and Ramp Network and a handful of others. I'm not sure about kind of currency support for those assets, especially in developing economies, but at least in the US, the fiat to crypto bridge is actually pretty smooth now. And then the last thing I'm looking for is really, especially for DeFi, is being able to do uncollateralized or under collateralized lending. And so having the risk models, and whatever that takes to make that happen, that likely means some form of persistent identity. It's unclear how much of the legacy system you need to bring forward. versus what you can kind of underwrite anew in these systems, that is still very kind of TBD. I think the DeFi community generally needs to be looking to hire a lot more experts out of traditional risk scoring type of places, so places like Experian and TransUnion and large banks, people who have a lot of experience and who have kind of seen the evolution of risk in these systems over long periods of time. My sense is that there are very few, if any, people from those backgrounds working in crypto today, and I think those are the kinds of people we need to kind of get into the ecosystem to really push this stuff forward.
Great. Cool. Well, thanks both of you for joining today. Really appreciate it. Thanks everybody who dialed in and for your questions and your participation. We'll be sending around an email with a recording of the webinar. For the guests, Kyle, tell us where people can get in touch with you and learn more about Multicoin.
Yeah, so you can get in touch with me on Twitter. My Twitter is just my name, @KyleSimani, or you can email me. I'm very responsive on both formats. My email address is kyle@multicoin.capital.
Great. And Jordan, for you, best way to get in touch and learn more about Scalar?
Yeah, I think Twitter and email are both great channels. I'm jcliff42 on Twitter and Jordan at scalar.capital.
Great. Well, thanks again, guys, for joining. And hope everybody has a great day.
Thank you.
Hey, Galen, thanks for hosting us. Bye-bye.